Hi, everybody. We're back with interviews with Dan from Absolute Mortgage. This is part 2 of the installment, and so we're just going to jump right in and ask the question. So, Dan, what is the best interest rates today?
Okay, so we were filming this in April 2019, and the rates are always changing. We saw last year how they went up quite a bit,
Right.
and there was kind of a stall in the market, became difficult, or a lot of people just didn't want to buy, refinancing slowed down. So, but then the rates started coming back down, and right now we're kind of in a great place, and we're hoping that they're going to continue to go down because the Federal Reserve said that they're not going to increase interest rates for the rest of this year. So hoping they continue to go down. We're in the 4s right now. We might get down in the 3s, but if I give specific rates today, they're going to be changed in a couple of few weeks. So they're just always in flux, it seems like, but hopefully this is a good time to buy. And if you can hold out to the summer, you might have an even better time to buy.
Oh, that's great news. Great. And so how does your credit, like to get a good rate on a loan, what does your credit have to look like, or how does that?
Usually about mid 700s or above, you're going to get some of the best rates out there. And then as your score drops, your rate is going to edge up a little bit. About every 40 points or so, you might see the rates go up right now about 1/8%. So the lower your credit score goes, they consider that more risky, and so they ask for a little bit more of a rate to help compensate for that risk. The credit score really is exactly that, about the risk that the lender takes for giving you that loan. The credit score is advised to help the lenders know how likely a person is to default on a loan within the next 24 months. That's the whole thing around the credit score for the mortgage industry. Now, something to remember is that credit card companies, car companies, mortgage companies, the industry itself has its own standards separate from the other lending type organizations. So they all have different parts of your credit history that they emphasize, and so the scores are going to look very different. If you go to Credit Karma or you get one of the credit reporting agencies to give you your credit score, it's going to be different than when we pull it for you. Usually we're going to have a lower number than what you get with Credit Karma and things like that. It's just the algorithm is different. Nobody really knows what it is, but it's just going to be different. And that's a big point of contention a lot of times. Some people come in and say, well, I have a credit score of 720. And then we run it and it's actually 695, which still isn't bad, but sometimes it can drop 20 points or so. I have seen it actually be higher than what they thought, but typically it's a little bit lower. So don't be surprised when you see that.
Oh, that's good to know. Yeah, thank you. And so when you run the application to get pre-approved or pre-qualified, a lot of people ask me if it's going to hit their credit. They're worried that it's going to be a hard inquiry. Is that true?
Typically, when you get any kind of inquiry, there's going to be some type of hit on your credit score. What we think, because the guidelines from the reporting agencies are not clear exactly, but we think that if you go shopping for rates within about a 14-day period and multiple mortgage companies pull your credit, that should all show up as one hit to your credit and not 3 or 4 or 5 hits. One inquiry can lower your score about 5 points, but again, we're really not sure because your credit score is always in flux, and it's difficult to know what one thing did this or that to your credit score, what caused that change, and how much it affected it. A lot of, as an outsider, we just really don't ever know what's going to exactly happen to someone's credit, but typically we only see that show up as one hit to their credit. They kind of lump them together for you. So we do want to encourage shopping around. Now, if someone does tell you that they figured out the algorithms that the agencies use, they're probably not telling the truth because they don't reveal those, and we just can't know for sure exactly how they're figuring them.
Okay. And what are general documents required? Like, what are the basic documents that a self-employed client that has their own business would need versus somebody who has a 9-to-5 job?
Okay. Well, typically the big difference there is if you're self-employed, you're going to turn in your taxes, which will have your 1099 and your Schedule C. That Schedule C is something that we'll use to do a some figuring with things that you've deducted from your business, and some of it we can actually credit back to you to help you get qualified. So your adjusted gross income might actually raise in our eyes because of that. The other thing you mentioned is like a regular like W-2 employee. So you might need to send us your W-2s and your pay stubs. Other than that, the rest of the things are pretty standard. We'll need your taxes for the last 2 years, bank accounts for the last 30 days, in some cases 60, depending on that kind of loan you're asking for. A copy of your driver's license. All those things are always required. If you're getting a government loan like an FHA loan, we'll ask for your Social Security card. If you have a mortgage, we'll need things for that mortgage, or mortgage statements, tax bill, insurance, declaration page, your HOA statement. So all those things are standard depending on exactly what you're doing for your loan.
Gotcha. Okay. Awesome. And what are the main factors that determine if a lender will disperse a loan to a buyer?
That is a huge list. If I were to write that out, it would take like a whole roll of toilet paper, I think. It's huge. There's so many guidelines. So let me kind of start with where the funding comes, how it gets determined, I guess. Every bit of information goes through a person called the underwriter, and that person is the one who is officially responsible for making the decision. They have about 1 million different guidelines that they must follow in order to make that decision. And the lender is trusting them to be that person that vets all the documentation, make sure that they're really qualified for that loan, make sure that they are the person that they're saying they are, because there's a lot of fraud in the mortgage industry. Yeah. And so that underwriter is really the last step in the whole vetting process. So that person is the one who says, we should give this loan, they qualify for it, or we shouldn't, they don't quite qualify for it. There's too much risk, or nope, the risk is great, we'll go ahead and fund the loan. There's just way too many factors to really try to list them all, but some of the main ones are the documents that we just named a minute ago. They're going to go through all those documents with a fine-tooth comb and make sure that everything's on the up and up. And again, they're going to analyze the risk and make sure that that they are a good risk and they're not going to foreclose in the next 24 to 48 months. The number of years that you've been on the job is going to come into play. Usually they want to see 2 years in the same industry at least, or if you've just gotten out of school, you can do about 1 year in that industry. Debt to income ratio, I mentioned that earlier, your DTI, debt to income. That means the amount that you're required to pay each month in relation to your gross income. Okay. So if you have about a 35% DTI, that's good. You should be able to qualify for most loans that way. The mortgage that you are gaining through this process is actually worked into that DTI. So it's all counted. So at 35%, that means that you still have, most of your income that's still you're spending on groceries and other things like that. So they just want to really make sure that your DTI is in a good spot for you to afford this house. They're going to look at the reserves you have in your bank accounts and make sure that you're able to cover the down payment, the closing costs, in some cases 2 months of mortgage payments, your escrow, which will be your taxes and mortgage insurance if you have it. They're also going to look at the bank account for cash deposits that might be large, look iffy. They're going to question you about that. They're always on the lookout for money laundering, so they're going to really be on the lookout for that with your bank accounts. Your ID will definitely be verified to make sure you really are that person. There's just so many things that happen. So be patient. The world of loans has changed a lot since the 2008 crash. They really have created a lot more guidelines to protect us all so that doesn't happen again. It does make the loan process kind of lengthy. We can close within 2 weeks if we need to. By the time you hand us a contract, we can get all that all done if all your documentation comes in quickly. But there's just a lot of hoops to jump through. And that's why we're here. Then so many people just have so many requirements that they have to meet, but your loan officer and your realtor we're here to help guide you through those steps, and we want to see that this is a smooth experience for you.
Yeah, that's true. Thank you so much, Dan, for your time and answering all of these great questions and your knowledge and everything like that. So thank you so much. And so this is a wrap on the interview with Dan questions. And so if you have any other questions that came up as you were listening to Dan, or if you just want to see if you qualify or what you need to do to get started, feel free to reach out to Dan or I, and we can definitely help you. And our contact information will be in the description below, so you can reach out to us. So thank you so much for your time, and you have a great day.
Thanks, everybody.
Bye.